Reddit is one of the more interesting social media companies. It's one of only a few that are growing users from the North American region, which are the most attractive users in terms of advertisers and marketers' willingness to spend to gain the attention of those users. But what's a fair price to pay for Reddit stock? That's the question I'm going to answer in this video, evaluating the company doing the discounted cash flow valuation model to determine what I feel is a fair price to pay. Let's get into it. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So Reddit's market cap is $29.35 billion. It has zero long-term debt and $1.75 billion in cash and short-term investments. I need all of these numbers as inputs to my valuation model. I also need the number of average diluted shares outstanding at 192 million. I'm going to incorporate Wall Street analyst estimates for the company's free cash flow expectations over the next 5 years. According to Wall Street, they believe the company will report $250 million in free cash flow for 2024, increasing to $360 million in 2025, $520 million in 2026, $1 billion even at 2027, and $1.16 billion in 2028. Needless to say, Wall Street analysts are bullish on this company's prospects over the next 5 years. I also need the company's beta, but I could not find a valuable betas to incorporate. The number is blank here for Yahoo Finance. I also looked at several of my other sources to get the beta for this company, and I was unable to find. And it's probably because the company has not been trading for that long of a time for data to be collected on its beta. So what I chose to do is use an estimate of 1.25 for the beta, and then I did a scenario analysis of a different beta because there's so much uncertainty about what the actual beta for Reddit stock should be. All right, so now that we have all of the inputs, we can go ahead and jump into our financial model for Reddit. Let me draw your attention first to the $250 million in free cash flow forecasted for 2024. That's expected to rise all the way to $1.16 billion in 2028. I incorporated Wall Street analyst estimates for those numbers. From 2029 to 2034, I utilized my own forecast, forecasting the company's free cash flow will grow at 23.5% annually between 2029 and 2034. From 2035 onward, I have the company's free cash flow growing at a 5% rate into perpetuity. So these are free cash flows expected in the future. We need to discount them back to today, or we need to bring these cash flows, we need to move them back in time to today so that we can get the intrinsic value of the stock today. To do that, we use a weighted average cost of capital, which I have calculated at 12% for Reddit, using a beta of 1.25, a risk-free rate of 4.75%, a market risk premium of 6%, and since the market cap is $29 billion with zero debt, I gave the company target capital structure of 5% debt and 95% equity. You might say, why did I give them a target capital structure of 5% debt when they have zero debt? The reason I do that is because nearly every company would like to have some debt at some point in the future, and it's because the cost of debt is so much lower than the cost of equity. You can see here, I've estimated that if Reddit were to borrow money, it can borrow money at around 7.5%, but its cost of equity is 12.25%. So its cost of debt would be more than 4% lower than its cost of equity. So it would prefer to have some debt to mix in with its equity. Now, in the early stages of a business, they may not want debt because the interest rate is higher, and so they choose not to borrow money. But in the future, as the company's free cash flow expands and the company feels comfortable about its free cash flow, then it can take on some debt because it'll feel comfortable that it can make the interest payments on that debt without hurting the business. In fact, it will help the business, its overall valuation, if they incorporate some debt into the capital structure. Nearly every company, when they get larger, they take on some debt. You've seen some big companies like Meta Platforms take on tens of billions of dollars in debt, even though they didn't need it. They did this because the cost of debt is so much lower than the cost of equity. So they borrowed money, they bought back shares, they paid some dividends, they find profitable employment for the capital that they borrow. So that's why I give them a target capital structure of 5% debt and 95% equity. So when I take the present value of the company's operations, I get 28.4 billion, and when I add the cash balance, I get a value of equity of $30 billion. When I divide that by the number of shares outstanding, I get an intrinsic value per share of $156, compared with the current market price of $167. So that would suggest that the stock is fairly valued because the market price is so close to my intrinsic value per share calculation. I like to give a 5 to 10% range of a margin of safety before I call something overvalued or undervalued. In this case in particular, I would lean towards the 10% margin of safety because remember what I said about the beta being unavailable? So I estimated the beta at 1.25. So given that higher uncertainty, I would create a wider margin of safety. So I would lean towards that 10%. So any price between $140 and $185, I would call fairly valued for this stock. Now, I did a scenario here where I lowered the beta from 1.25 to 1. And if I do that, the intrinsic value per share rises to $204 per share. You might be curious why the value increases when I decrease beta. Beta is a measure of riskiness. And so if I decrease beta, what I'm saying is that the stock is less risky. And all else being equal, if a stock is less risky, you should be willing to pay a higher price. I know I am. So that's why when I lower beta, the intrinsic value rises. And the beta is incorporated in the discount rate. So mathematically, it increases the present value of the cash flows that are expected in the future. So that beta calculation brings it down to $204 per share. So to answer the question, is this undervalued? I would say it's between undervalued and fairly valued, depending on the beta that you think is right for Reddit. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.